Private credit is the fastest growing asset class in institutional finance, and 2025 was the year it went mainstream. BlackRock projects that private markets overall will grow from $13 trillion today to over $20 trillion by 2030. Private credit specifically, which includes direct lending to companies outside the public bond market, now represents approximately $2 trillion and is on a steep growth trajectory. The driver is structural, not cyclical. The 2008 Dodd-Frank regulations caused banks to pull back from mid-market corporate lending. Private credit funds stepped into that vacuum, offering floating-rate loans at 8% to 12% returns. When interest rates stayed higher for longer, those floating rates translated directly into higher investor income. The five dominant managers, Blackstone Credit, Apollo, Ares Management, Blue Owl Capital, and HPS Investment Partners, collectively manage trillions in assets. These firms now rival the major banks in their influence over corporate lending markets. Private credit has historically been available only to institutional investors and endowments. But retail access is expanding through a vehicle most investors have never heard of: business development companies, or BDCs. BDCs are publicly traded companies that invest in private credit, direct loans to mid-market businesses, and trade on stock exchanges like regular stocks. They are required by law to distribute at least 90% of their income to shareholders, making them high-income investment vehicles. The major BDCs include Ares Capital Corporation, ticker ARCC, the largest BDC with over $20 billion in assets; Blue Owl Capital Corporation, ticker OBDC; and Golub Capital BDC, ticker GBDC. Most yield between 8% and 12% with monthly or quarterly distributions. The pros: genuinely high yields, low correlation to public equity markets, and senior secured positioning that provides some downside protection in defaults. The cons are real. The underlying loans are illiquid. You can sell BDC shares, but the fund cannot quickly liquidate its loan portfolio. Credit risk is genuine, especially in 2021-2022 vintage loans made at near zero rates. And complexity: BDC financial statements require careful reading. For most retail investors, a 3% to 8% allocation to BDCs via ARCC or OBDC provides meaningful private credit exposure within a liquid vehicle. This is the disclaimer slide. All content in this presentation is for educational purposes only. It does not constitute investment advice. Viewers should consult a licensed financial advisor before making any investment decisions.